Thank you, everyone. So as Peter said, I haven't spoken, I think he meant in public for a year. So I might be a little rusty, so please forgive me for that. So, you know, I've always been passionate about technology and innovation, and in particular about how innovation can drive costs down and create opportunities and expand access to broad masses. And also, I can't stop being amazed with how quickly innovation, at the pace of innovation, how quickly innovation gets to the next level. So marketplace lending or online lending, or at the time peer-to-peer lending, really emerged about 10 years ago. There was Zopa in the UK, Prosper and Lending Club in the US, Credit here in China. And just to all speak from the same frame of reference, let us remind ourselves what happened in the last 10 years. So that's what a mobile phone looked like 10 years ago. It was a good old Nokia flip phone. Great innovation at the time. And that's what a mobile phone looks like now. Not just what it looks like, but also think about the amount of data, the amount of computing power, and really all the knowledge that can be acquired and shared for these devices, and how much this has changed just in the last 10 years. So this is great, but technology innovation is a continuing process, and it's also good to remember that before Nokia could come up with the flip phone, there were a number of predecessors and of companies and devices that really paved the way for Nokia to come up with that phone and then quickly be outdated. So I think that process played out a little bit in a similar way in online lending. And while there's been a lot of evolution in the last 10 years, I think the initial evolution 10 years ago was amazing and created a lot of value for millions of people around the world. So I think online lending 1.0 was already a great innovation. Just to back that up a little bit, let's go through for what it brought to the table. I think one of the main innovation, one of the main benefits was really a massive cost reduction. So that's this survey that's been done by a number of consulting firms around the world. And in the US, we established the fact that online lending helped platform operate at a 400 to 500 basis point lower cost than the banks and other traditional lenders. And we're able to use technology to automate tasks that would otherwise be manual and do away with a lot of the physical legacy infrastructure, including the branch network. And so that resulted in massive cost savings. And these cost savings translated into lower rate for borrowers and attractive returns for investors. We also used technology to bring sort of more data. While banks were very good at using credit history and bank account data and other data points, I think with online lending, we were able to access data points that were only available online, and we called that the online footprint. And we used it mostly for fraud protection and fraud prevention in consumer loans. But in small business loans, we were able to use more of that footprint and that online reputation as part of the underwriting. We were also able to connect to more data sources and bring into the underwriting things that were previously ignored by the banks, like utility payments, so payments on your utility bill, on your water and telephone bill, which did not show up in the credit report in the US. So these improvements in cost and underwriting really helped us as an industry generate really attractive returns. So this is a return page from Lending Club. You'd have something similar from a lot of the other platforms in the US, whether it's Marlet, Prosper, Avant, or SoFi. And so online lending generated over the last 10 years about 5 to 7% net return for investors, which in this low yield environment was really attractive. Not only returns were attractive for investors, but these returns tend to be uncorrelated to other asset classes, which is a great benefit when you're an investor and you're thinking of your asset allocation and your portfolio allocation to see that you're getting yield and you're getting the benefit of diversification. And I think the highest correlation on this chart, just to remind everyone, the correlation of 1 means 2 assets move in the same direction at any point in time. The highest correlation here is less than 0.2. It's with high yield bonds, which is also a good alternative for yield investors. So a lot of benefit to investors from sort of online lending 1.0 that really sort of helped platforms around the world over the last 10 years grow at a very fast pace and become really massive consumer success in terms of borrowers being able to lower the cost of their credit, as well as investor success with a lot of individual and then institutional investors investing in the asset class, with the sort of combined cumulative origination coming from about $1 billion 5 to 6 years ago to 55 to 60 billion now. So massive increase fueled by this sort of innovation that was, again, centered around sort of reducing cost, improving underwriting, and delivering a great experience online. So 1.0 was great. And the Nokia flip phone was great when it came out. Now the world has changed. There's a lot that has come up, a lot of technology innovation, a lot of learnings from the last 10 years. And I want to talk about these learnings. I want to share my vision with 2.0. And 2.0 is not a single company. 2.0 is a set of technologies, tools, principles, processes that I believe are being implemented all around the world by marketplace lending platforms. It just so happens that Upgrade, being a new company, getting formed now, it's a lot easier for us to implement all these principles, all these processes, this technology all at once. I think we'll all get there at some point. So 2.0 is, again, a series of many, many things, and we can't go possibly through all of them. I've chosen about 7 of them today that are really designed to improve risk management and investor returns, and to an extent, borrower experience. So in the category of risk management improvement, as I said, there's better technology, more data being available, and better tools to analyze that data. There are also new strategies in terms of servicing the loans that also help increase investor returns. And then there are new features that we decided to bundle with loan products that have to do with credit monitoring and credit alert, credit education, that we believe will help educate customers, educate borrowers to the point where they perform better, they make better decisions, and they have a more responsible use of their credit. And so all the data that we collect can also be shared with the borrowers and help them make these better decisions. Sorry. So, these are some of the risk management tools. In terms of investor experience and investor returns, we, in the process of creating Upgrade, we really spent a lot of time with investors and asked them, okay, what do you care about? And besides risk and returns, the 3 things we heard the most were liquidity, transparency, and alignment of interest. And we've tried to incorporate all that into the design of 2.0. And then there are some really fundamental tools we're putting in place in terms of ensuring better data integrity, better compliance, and make sure that all that data is actually kept in a safe place and used the right way. So as I said, starting with technology, the world has changed a lot in the last 10 years. And so this is what a sort of data center looked like 10 years ago. And we we all CEOs of online lending platform invested millions of dollars creating data centers and sometimes 2 data centers for redundancy and failover purposes. Now with cloud computing and with cloud-based infrastructure, this is what our data center looks like. it's essentially a call to AWS and so Amazon Web Services, and we can ask Amazon to get us a new load balancer, and we code for it, and the load balancer appears in our infrastructure a few minutes later. We can call for an additional web server, it appears a few minutes later. So this, this ability to, for many companies to pull resources into the cloud and access resources on demand is a cause for massive cost reductions. And we can see that as we built up Upgrade over the last year, and as we start to scale, again, there's been a massive reduction in the cost of physical infrastructure. And again, we can pass on these cost reductions to borrowers in the form of lower rates, investors in the form of better returns. Another fascinating development in technology over the last 10 years is really the architecture of microservices and the ability to componentize each service, each function of the software in a way that gives us enormous flexibility and an ability to react very quickly and deploy new code very quickly without having to redeploy the entire architecture. So monolithic architecture is what we had in 2007. Microservices is what it looks like now. And this ability to deploy code quickly, again, isn't for the sole sake of technology. It's really very impactful when you think of fraud prevention and you find a new risk that needs to be addressed right away. You need to release a patch within hours or within minutes. So now let's talk a little bit about data and our ability to access more data and process more data and use big data to do some variable generation and other ways to discover new attributes, new correlation. So one pretty sort of predictable data attribute we have all used in the last 10 years is the debt-to-income ratio. So if you look at the evolution of DTI in short, over the recent years, you're thinking, well, good news, DTI is down, so the US consumer is getting less leverage. Well, yes and no. When you start digging into the story, what's really down is mortgage DTI. And for a very simple reason, which is that since the financial crisis, the US has actually lost 1 million homeowners and gained 6 million renters. So there's been a shift in consumer behavior, partially caused by the housing crash, but partially caused by the sharing economy and the desire from younger generations to use rather than own assets, from homeowners to renters. And that has a very meaningful impact on underwriting, particularly as rents, partially because of that extra demand, has increased very quickly over the last several years, increased faster than other prices and clearly faster than salary. So the rent payment is becoming a greater weight in the overall spending. So that really pushes us to have a much more segmented approach to underwriting and really understand the cost of living and the fact that rent and housing expense, but also other cost of living expenses are dramatically different from one place to another. So very few 1.0 platform have incorporated that notion of really sort of location-based underwriting, which is, again, particularly important when you look at the disparity between, let's say, someone who lives in New York City and someone who lives in Greenville, South Carolina. That difference in cost of living can be 50%. So it's, again, massive difference that have a very high repercussion on the underwriting and on the amount of free cash flow and income that a person needs to be able to pay back the loan. As much as 1.0 brought some new data to use, 2.0 brought its own sort of data set and increment with, again, more location data based on the person's residence and place of living, but also with mobile phone increasingly based on that person's location at any point in time, particularly when you start thinking about retail financing and point-of-sale financing. And then the notion of free cash flow that we've implemented in the underwriting and is really a core part of 2.0 that really helps lower risk tremendously and correct for this disparity within the DTI calculation. The free cash flow takes into account a number of things that were not picked up by DTI, including tax payments, including housing expense other than a mortgage, and including general cost of living expenses. So a lot of data has become available to us over the last 10 years. There's better connectivity, access to more data sources. But I think this data can be shared with the borrowers and really help borrowers get a better understanding of their own credit situation and how they can improve it. And so in 1.0, the idea was really sort of mostly we make a loan and then not much would happen for a few years until maybe we make another loan. That really didn't create a lot of engagement, a lot of sort of customer loyalty. And so we believe that a series of credit monitoring and credit education features will be sort of great features for consumers who are going to learn about how to become better at managing their expenses and their credit, but also a way for us to have an ongoing dialogue with our customers by showing them their score, by showing them alerts, by showing them trends, and by giving them simulations and help us understand what happens when they take any particular action on their credit. Now, as I said, 2.0 is not all about data. It's also about processes and about business model to an extent. So one of the three things besides risk and returns we heard from investors, again, was about alignment of interest. So I believe a lot of the 2.0 platforms are going to invest in all of their loan production and share the risk with investors. It's also about transparency. And I believe part of 2.0 is being fully transparent about the credit policy, about the amount of verification being done by the platform, about what income is verified and what income is not verified, and about the evolution of the consumer health and the portfolio with a monitoring pool on a monthly basis, and with a lot of tools being made available and a lot of standardized data sets being made available to investors. We announced a few days ago our partnership with DV01 that's going to help us do that. Another requirement or another part of the wish list for investors was clearly more liquidity. I think more liquidity can be obtained in a number of ways. Two, I think, easy way to make the asset class more liquid is the use of securitization, and that's already been adopted pretty broadly by a lot of the platforms, so coming up with their own branded securitization shelf. But then another way to get there is just pass through securities. And so we've been sort of putting a structure together that really helps platforms sell loans to a partner, an intermediary. Could be Jefferies, that's been pretty active in the space, could be any other intermediary. Then for that intermediary to issue pass-through securities to the investor so that the investor can own security, can have a QSIP in the US, can track it on Bloomberg, have standardized documentation, and eventually create more liquidity by creating this bond. Now, all this data, all these improvements need to be sort of relied upon by everyone. And so to make sure there is full data integrity, another sort of 2.0 mechanism of that's really sort of an innovative way of establishing more data integrity is the use of the blockchain protocol, which is the underlying protocol for cryptocurrency. But it is also the way we are using it, a mechanism to create a time-stamped immutable record of every transaction. When the transaction happens with a borrower, when the borrower signs or agrees to terms or signs an agreement, that agreement can be hashed, can be pushed to a public blockchain attached to a small transaction, and that creates a timestamp of that particular and a record of that particular document. And if that document was ever changed, then the hash would change as well, and investors or auditors could see it in the open. So that particular mechanism we thought was a really sort of innovative way to use the blockchain protocol for the greater good. Now, I see I have only a few seconds left. I wanted to, as a parting thought, give you this picture. First, because those are really good-looking cars, and I thought it was a good way to part. But also, just to make the point that technology innovation can go into different ways and can be used for different purposes. In the case of Bugatti, they clearly use technology innovation to build a faster car, arguably a safer car, but not necessarily a cheaper car. Actually, in constant currency, the car on the right is more expensive than the car on the left was at the time. And so I think what we want to do, and what I invite a lot of the platforms to keep doing, is use technology innovation and better data to continue to drive costs down and continue to improve the underwriting so that we can continue to make credit more affordable for consumers and businesses and continue to deliver great returns to investors. And if we take care of these two things, the industry will continue to grow and will continue to improve the lives of millions, tens of millions, hundreds of millions of people around the world. Thank you very much.